ladies and gentlemen, good morning to you. I'm going to be talking on a topic which is a little opposite to what Sandeep spoke about, which is real estate. Many of us have personal experiences, but investing directly has its own experiences, and investing through the fund has its other experiences. Let me take an example from my own life. Like most of you, I also invested in real estate. I thought I can have 3-4 apartments. In Mumbai, I had bought 2-3 apartments. I bought one apartment 20 years back, bought it for 50 lakhs. After 20 years, I could sell it only at 1 crore. On paper, I've doubled the money, but on reality basis, I've actually lost money. If I'd put that 50,000 rupees in Sandeep's fund, maybe I would have made 5 crores. Or if I'd put the 50 lakhs in, Sundaram Finance stock, it would have been 50 crores. So the question that comes to one's mind is, should we really have to invest in real estate? And should we have to really invest into real estate through credit? It's a question of asset allocation. So the topic today that we're talking about is real estate credit investing. The closest comparison that I can bring to you is, if I had invested in my RE fund, Sundaram RE fund, 7 years back, I would have made 2.5 times money, which is a debt investing at a compounded basis of about 15%. So there is a story here. The problem is real estate investing in the recent years had a bad history due to various reasons, because of which all of us, or most of us in this room, would think real estate investing is a bad idea through AIF. So let me take you through this in a manner that will make you understand that not only I have to put most of my money in equities, as a part of my asset allocation strategy, which is your job to advise a client, you will allocate some part of the money to debt. This is a product which is investing in debt. Basically, an AIF, it's like a housing finance company, lending money to real estate through a debt platform. Have I put this perspective in place? All right, let's go. I'm just giving you a quick assessment about the markets so you can understand how real estate is going to be a very important component of your investments. The first thing that you must know and realize is that real estate as a part of GDP is going up from 7.5% to 15%. That's the very important part. We all know that India's GDP is going to be growing at 5 trillion, it's going to become $5 trillion. And 15% of that, which is about $750 billion, is going to go to real estate. Of that, why is that coming to be so good? Why the size of contribution is increasing? That's mainly because of the fact of government policies, increased urbanization, and recovering of the economy. This has led to massive urbanization in the sector. Why? Because people are earning a lot of more money and they want to buy a house. And for that, you need funding. There's a significant requirement for funding that is happening right now. So, when you are trying to build up a real estate business, the developer needs funding. And more so, he needs debt funding, right? Just to give you some statistics here. Debt financing opportunity for 2024 to 26 is 14 lakh crores. That's a huge number, yeah? 10 lakh crores has been sanctioned in the last 5 years. It's expected to grow at 40% from the next 2 years, between 24 to 26. What are the funding requirement for? Construction finance, long-term debt, and lease rental discount. These are the areas where they need funding. So therefore, debt financing opportunity in the next 2 years is about 14 lakh crores. It's a huge opportunity waiting to be tapped. Now let's understand this thing better. What happened between 2010 to 2020? Government policies transformed. The first thing that we are talking about is IBC, RERA, GST, and RI REITs. It's a formalization of the financial part of the economy. This has led to better recovery and therefore confidence in lending. This is how we are seeing the transformation of government policy has led to the confidence in lending in the industry. So this transformation is something has changed or revolutionizing this entire industry right now. So how's the opportunity for AIFs coming up? 70% of the sanctions are done by private sector and public sector banks. But there's a 30% gap, which is 40% of the Indian real estate market in the retail side needs 6 lakhs crores. If 70% is done by banks and NBFCs, there is a balance 1.5 lakh crores that needs funding. Who's going to do that? That's AIF. So there's a significant gap between the fund required and the fund that is available. And that gap of 1.5 lakh crores can be filled in by AIF. That's where your investors or institutions can come in and participate in this. So just to give you a statistics as far as March 2024, what has been the participation so far? AIF investments has touched about 4 lakh crores. Commitments has been about 11 lakh crores. Interesting aspect that I want to share with you is real estate has attracted the highest amount of money, which is about 68,000 crores. Almost 2.5 times more than the next participant, which is IT and ITES. Did you know this? That's the amount of money that has come into real estate so far. Domestic investors have participated to the extent of 2.8 lakh crores. FPIs are far behind at 18,400 crores and NRIs are at about 15,000 crores. In the AIF part, equity and equity-related investments is about 2.5 lakh crores. Debt and debt-related investment is about 1.16 lakh crores. Now you can see how AIF are taking the space in the market as of now. So what are the key mega trends that is happening right now? We all know that India is the fastest growing GDP in the world, large economy GDP that's growing in the world right now. It's growing at about 6.8. Some are saying it's 7.2%. What is most important thing is this, per capita GDP. We are inching towards $3,100 per capita. What happened in China? Once they breached the $3,000 per capita, the economy started booming. What did it do? It led to consumption rise, increased income, increased urbanization, increased jobs. When there's a rapid urbanization that happens in the country, there's a requirement for housing. If there is a requirement housing, there's a demand for housing, there's demand for funding. And that funding gap comes from banks up to 70%, but there is a balance 30% that needs to be funded, which will come from the alternate investment universe. That's where the role of an alternate investment fund manager comes in, right? So rising income levels, rapid urbanization, a large talent pool because of the fact that Indians are very well educated. All these talent pools will come to cities where there's requirement for housing, and those things will lead to strong domestic demands, and that will lead to the growth of real estate business. Also, what is happening is, within this growth structure that we are looking at, the overhang in the real estate sector, which is the inventory overhang that we have been seeing, is the lowest in the last 10 years. If you see this, from 40% it's come down to 17%. The inventories has come down to the lowest in the last 10 years, and the pricing, though in absolute terms it's gone up by 42%, in inflation adjusted rates, it has actually come down. That means what? The affordability of real estate has only been better as we go along with time, right? Second important thing that you must know is the developers are deleveraging their balance sheets. That means because of sales increasing, they are paying back their loans faster. the balance sheets are becoming lighter. All right? And the last thing, which is a big opportunity for us, is this, that regulator, the RBI, has started putting restrictions on NBFCs and banks to lend towards the real estate sector. So that throws up an opportunity for alternate investments to participate and start lending to the sector. So what are the type of deals that are available in the market for you to understand this better? So majority of the money would come for project financing, which is 50 to 60% of the portfolio, and targeting yield of 17 to 19%. Interim financing, which is about 15 to 20% of the portfolio, targeting an yield of about 20 to 22%, and enterprise rescue, which is about 18 to 20%. So overall, the goal is to achieve a return, targeted return of 18 to 19% over a period of 5 years. That's the benefit of investing in real estate debt. Tell me a debt mutual fund, how much it gives? It gives about 7%. A fixed deposit gives you 7.5%, right? Post-inflation, post-taxation, it is negative return. A real estate investment, it's targeting 19%. At the investor level, it'll come down to about 15 or 16%. Post-tax, post-inflation, you're looking at about 10 to 11% in the hands of the investors. So you're making real returns beating inflation. That's the most important point that you need to know here. So what's the platform like? Just to give you a quick perspective, I don't know how many of you know Sundaram Finance as a group. It's one of the oldest NBFCs in the country, incorporated in 1954. It is the first NBFC to be listed in the Bombay Stock Exchange. Way back in 2004, the market capitalization of Sundaram Finance was about 500 crores. Today, in 20 years down the line, it's 50,000 crores. It's a trusted name in the South, very, very conservative, under the radar, and a very respected name. It was part of the TVS group. Now the family separated. It's now become a Sundaram Finance group, right? The group of companies are Sundaram Mutual Fund, Sundaram Home Finance, and Sundaram Royal Finance. And Sundaram Alternates is a subsidiary of Sundaram Mutual Fund. One of the fastest growing alternate asset companies. We are managing about 7,000 crores. One of the few alternate asset management companies which offers options to invest in both equity, performance credit, debt, and real estate. I don't know how many of the alternate asset management companies that are available in the country which can offer investment opportunities across asset classes. The latest launch that we have done is debt PMS, which we can talk separately at a later point in time. So, important outcomes that I want to share with you is this. Since 2017, we've been investing in the real estate fund through 4 series that we've done so far. Cumulatively, we have managed about 3,500 crores. We have done about 51 deals and not a single default. We have gone through COVID, we have gone through GST, we have gone through RERA, we have gone through demonetization. Not a single default has happened in the investment that we have made across 51 companies so far. What is the role of the sponsors and the affiliates? The Sundaram Group participates in the fund to the extent of 20%. What does it mean? If you're raising a fund of about 1,000 crores, Sundaram Finance will invest 200 crores. This shows Sundaram Finance commitment to this fund. It is also showing the commitment of Sundaram Finance is aligned to the commitment of the investor. This also means that Sundaram Finance participates strongly in the risk management process, in the lending process, and therefore ensuring the risk is not out of whack when we invest in a particular company. That's the biggest comfort an investor would be having when coming into Sundaram Real Estate Fund. Cumulatively, we have done about 2,500 crores, and we have launched 4 series. And today we are in the 4th series, which is about close to 500 crores in size. So just to give you a summary how this looks at the moment, the first fund was launched in 2018, which was about 400 crores. 100% of the capital has been returned in 2022. It was a 4-year fund. Gross yields that we got is about 19.5%, close to 19.5%. The second fund is 435 crores. It's 100% invested. We have already returned 25% of the capital to the customer. One of the most important things you must remember in this RE funds is that we make a quarterly payout. Every quarter, investor will get about 3 to 3.5% back to them. Right? So by the time the fourth or the fifth year comes in, the investor has recovered close to about 40 to 50% of his capital that he's invested. So investor gets cash flows every quarter. The investor gets his capital back by the end of the fourth or the fifth year. Right? So now this is the CAT 3 fund, the RE3 fund where we raised about 558 crores. 19.2% has been paid out. This number that you see here, the DPIs, which is the distribution thing that happens. In this fund, 75% of the fund has been distributed. In this, 136% has been distributed. In Fund 3, we are already distributed. Now, at the moment, as of we speak today, it's about 25% of the capital has been distributed. Right? So, how do we manage this? In real estate investing, there are 5 kinds of risk. The first is land acquisition risk. This is where the problem starts. To acquire a large piece of land in India is not easy because there are a lot of stakeholders who are involved in the process, right from politicians to the cops to the local goons and all this kind of stuff. So when the investor comes in to buy a land, he thinks he'll do it in 6 months, but actually it takes about 2 to 2.5 years or 3 years. So we don't get into land acquisition. So we mitigate that risk. The second risk is the approval risk. Getting approvals from municipal corporations, environmental ministry, that takes more than 6 months. So the life of the fund is 5 years, but you're taking 3 years just to acquire, you lost the game. So we don't get into approvals. What it means is we don't get into greenfield investments. The next risk that we're talking about is the construction risk. We get into projects where the construction is already 20 to 30% done. Right? What does it mean? The approvals are got, the land is in place, the promoter has already put his money into the project, and therefore the construction is already started. What does he need? He needs help to give him growth capital. That's where we come into the picture. We not only do that, we typically, when we lend money to a builder, what we do is we take the guarantee of the project. Not only that, we take another 2 projects, which is having cash flows, we take that project as a security as well. So for every project, there'll be a backup project, which is a security for this project. And the fourth risk is the velocity risk. We as a fund, sales velocity risk, okay? We as a fund are always focused in the budget segment of the housing. We are not in the affordable segment. We are not in the luxury segment. Why is the budget segment? Budget segment is between 50 lakhs to 1.5, 2 crores. People like me who are working would want to buy a house. We would want to buy a house which is affordable or within our budgets. And when I want to buy a house, I take a housing loan, right? The penetration of the housing loan in this segment is close to about 70 to 75%. What does it mean for me? It means that every time a slab comes up, the housing finance company is funding that slab. When that funding happens, it comes to me back as a lender. So my cash flows are taken care of. The velocity of that cash flow is also taken care of. Now the fifth risk is when the slowdown of the sales velocity of that particular project. So what we do in that kind of scenario is that the supporting project which you have already taken, which already has sales, is something, those cash flows are also landmarked to us. So we are taking care of that. Last but not the least is the location risk. We ensure we invest in projects which is very strategically located so that the velocity of sales is not slowed down. Like for example, an IT park in Bangalore, or a manufacturing park in Pune, or a place in Chennai, or Gachibowli in Hyderabad. These are the places where the urbanization is happening rapidly and people are buying house at a very fast pace. In those places, the sale of real estate is at the highest, right? Other than that, we are the sole lenders to the project. We don't co-lend with anybody else because we want to be in complete control of that particular project. If in case of any problem that happens, we are able to recover the money from the builder at that point in time. And like I said, we focus on mid to late stage profitable projects only. We don't get at the starting stage of buying land. All cash flows are swept into our escrow accounts. If you see this, the risk management that we follow ensures that we completely get out this builder 360 degrees and he doesn't have a chance to default at all. So at the fund level, what are the risk management techniques that we have? We have an exposure up to 10% of the fund. A single borrower cannot be more than 15%. Max tenor deals is about 4 years within a 5-year fund. We don't lend beyond 4 years. What does it mean? That the money comes back to us before the fund closes down. This is the asset liability management that we take care of. Many of the lending is as less as 2.5 years. What we do is we recycle that and then reinvest it for a shorter period of time so that the IRR of the fund starts increasing. Right? Focus city-centric projects, and our sweet spot is between 50 lakhs to 1.5 crores. So at the credit level, what is the risk management we do? We secure it 2.5 times, 100% cash flow that is lean to us, minimum 2 approved projects, which is the support one I said about. All are amortizing investments. We don't do any back-ended deals. What it means is every quarter that I'm making a payout to my customer is linked to the payout that happens at the builder level. So the quarterly payouts that happens is basically the interest payments that are coming from the builder, which is paid into the fund, and then the fund pays it back to the investors. So it is self-amortizing investment that we do, and therefore quarterly interest payments. And so far, we have not defaulted in the last 7 years, even a single quarterly payment to our customers. So this is regular monitoring that we do. Escrow balance monitoring, sales and cost monitoring, construction projects monitoring, follow-up on debt obligation. These are all intense process that we follow on a daily basis to ensure there is no deviation from the objective of the fund itself. So just to give you a sample fund, give you an idea, there are deals that are being done. Please remember, we are a very south-focused lending company, lending area. We don't come out of south at all. At best, in the last fund, we started lending money in the Mumbai market and the Pune market. Why south? Because we are very comfortable. Our ecosystem is very effective in the south. Sundaram's lending culture is known in the south. The relationship Sundaram Finance or Home Finance has for the last 30 years with builders, we know the builders' history, geography, everything inside out. We are very comfortable with this scenario. And therefore, any red flag situation that can come up, we get to know the best in those markets very fast so that we can take those mitigation steps as quickly as possible. So just to give you an idea, if you see Bangalore, Chennai, Cochin, Bangalore, Chennai, Bangalore, Hyderabad, Coimbatore. We got 575 crores, deployed about 547 crores. Security cover, if you see, is 2 times, right? Average tenor, if you see, is about 3 years. And the gross IRR we got is about 19.3%. Right? Now the current fund that we're operating now, you can see the name Mumbai has got included. Total deployment, we raised about 500 crores. We have deployed about 250 crores. The cross coverage is about 2 times. Average tenor, if you see, we have not touched 5 years at all. It's 4 years, right? And it's about 19.2% gross yield that we are working with right now. So typically what happens in a 5-year fund, we don't hold it till 5 years. We start paying you back from the 4th or the 4.5 year to the customer itself. In addition to the quarterly payouts, you start getting your capital back as early as possible. So just to give you a quick idea, what are the kind of funding we do? Sorry. The funding we do is growth capital, which gives you an 18 to 20% IRR, structured financing, 18 to 20% IRR, interim and bridge financing is about 20 to 25% IRR. Where are the locations we are investing? 43% is in Bangalore because it's the fastest growing market. 30% 13% in Pune, 21% in Mumbai, rest Chennai and Hyderabad, balance 23% that we're looking at. Structured finance accounts for about 70% of the portfolio, 25% is growth capital, and 6% is bridge finance. The deals that are actively being pursued are these. If you look at the composition, is growth capital, structured finance. The kind of yields we are talking about, 18%, 20%, 19%, 19%. The total deal pipeline that we have is about 1,200 crores at a gross yield level of 19%. So if you come in today to the fund, you're going to lock in into an yield already available at about 19%. Historically, for the last 20 years, BSE Sensex has given about 15.5% CAGR returns. In comparison to that, if you look at it, now the markets are gone completely out of the roof. But on a 15 years basis or 20 years basis, BSE Sensex has given 15.5% return. This fund on a 5-year basis is giving you 19% gross returns. Is the closest benchmark that you can ask yourself, is this the right place to invest or not? And this is fully secured. So that brings me to the end of this presentation. Thank you so much for your time.